All right, everyone, welcome to another episode. Today we have Brian Murphy, who is the co-founder of Portfolio Advisors, a middle market private investment firm with over $38 billion in assets under management. Founded in 1994 to serve institutional investors, Portfolio Advisors offers a variety of innovative investment solutions across private equity, private credit, and private real estate. Portfolio Advisors merged with FS Investments in 2023 and now collectively manages over $75 billion in AUM. Did I get that right?
That's right.
Okay, awesome. Well, welcome in, Brian. Thank you for being here.
Thank you. Happy to be here.
Yeah. Well, I usually love to start by asking my guests a little bit about your upbringing. Tell us, would love to hear about your childhood or teenage years or anything that you felt molded you, influenced you to be who you are today.
So I was born in Utah, and when I was 3 years old, we moved to New Jersey. My dad finished his PhD in chemical engineering, got his first job with Johnson & Johnson's research and development group, and he was on the team that invented the disposable diaper.
Wow.
And so I spent my entire youth back east. We lived in New Jersey until I graduated from high school, and then my parents moved to Connecticut. So when I came to BYU, I kind of commuted. I drove between Connecticut and Utah. Had a pretty standard upper middle class upbringing. Two really terrific parents. My mom was a stay-at-home mom. There are 5 kids in the family, all of which are very creative, very successful. And, we were raised by parents who were thoughtful and kind and generous, but also entrepreneurial. My dad has some patents, and he started multiple businesses, and he always encouraged us to think that way. Instead of going and getting a regular job when you were a kid, what business can you start that you can earn an adult wage versus a kid's wage? And so I ran a landscaping business I started. I ran for many years a painting business that I started, and I was making what a professional painter was making when I was a kid. And so that just kind of created a framework for how do I think about work? How do I think about being my own boss? How do I think about income? And where does creativity and hard work fit into all that?
Yeah, that's great. I love the early influence and you taking that, running with it with some of the early entrepreneurial ventures you had. I saw you mentioned earlier before we recorded you went to BYU. How was that experience for you? I mean, being an entrepreneur from a young age with your landscaping and painting ventures, what was your thought process going into school? Was it I want to get a degree and then start my own thing, or I want to go get a job, get experience? And what was that like?
Well, I had a couple goals when I went to BYU. It was the only university I applied to. I happened to be LDS, and growing up in the East, where there are far fewer members, I dated a young lady that lived 120 miles from my home. So I was really excited to get out to a place where there were lots and lots of members of the church, and that it would be easy to date and make a lot of friends. And so I was excited about the social aspect. I also wanted to get a good education. I knew that they had a good business school. I had always been very interested in business. And so that was also something. And then lastly, my grandparents were from out west, and being in a middle-class family, we did not fly. And so my dad would save up his vacation, and every 3 years we would drive out west because he had saved up 4 weeks of vacation. We spent a week driving out west, we spent 2 weeks in the west, and then a week driving back home. And so I counted that I had seen my grandfather on the Murphy side 5 times before I got to college. And so there were many important relationships that I just didn't have because we just weren't close. And so getting out west allowed me to get to know these people, and they became very, very important people in my life.
Yeah, makes sense. And then what did you end up studying? What did you pursue at BYU?
So when I was a freshman, I actually decided I was going to be an orthodontist or an oral surgeon. And so I started in microbiology. I served a mission, and most everyone that was giving me feedback was like, you should do business. You're really good at that. Why would you go into the other? And I kind of viewed, being an orthopedic surgeon as being entrepreneurial, because you kind of have your own business. Sure. But everyone's kind of saying, look, your hands are too big. Yeah, just do something else. And so when I did get back, I tilted toward the business side and never looked back. It's been a great career.
And why did you decide to pursue a career in finance specifically. What was it about? I mean, and I couldn't find, Brian, much about your career prior to Portfolio Advisors, but yeah, what was about finance or investing that piqued your interest?
I've always had a curiosity, mostly healthy, but probably a little unhealthy, about money. And I was easily bribed by my parents when I was a kid, and I learned to work really hard. When I was a freshman and I applied to BYU, I had over $30,000 saved,
Wow.
which back in the 70s was a lot of money.
Okay.
And so for me, it was, okay, how do I drive myself forward to success? And I've never been diagnosed, but I have a lot of ADD tendencies. And so I wanted something where it was kind of quick bursts and, deal driven or loan driven or whatever it was. And so when I was thinking about careers, I thought I could be a consultant, I could be an investment person, I could be an investment banker. And so when I actually graduated with my master's degree from Columbia, I went into investment banking because I thought that would be where I could get kind of the 5 years of experience in 2 years. I wasn't afraid of hard work, and it would give me some really terrific credentials. So the whole world of finance fit pretty well with my interests, but also kind of my personality and some of my weaknesses.
Yeah, makes sense. Did you pursue your MBA at Columbia directly after your undergrad, or was there some time
Yeah,
in
because
between?
of the entrepreneurial things that I had done growing up and while I was in school, Columbia added to that my 2-year mission and took me straight in.
Got it.
I thought that was a brilliant stroke. I mean, I applied to Harvard and Stanford, and they all said, go work for 3 or 4 years. Columbia said, no, we'll give you credit for those things. They took me. So I thought, all right, I just saved 3 or 4 years, and I'm going to get further ahead in my career. Until I got to see my peers, and I realized we're all about the same age. They're a little bit older than me, but they have a lot more work experience than I do. And when we went to interview for our internships, I had this one study group, and I had one guy that had 13 first-round interviews, another one that had 11, another one had 9. I had 3,
Mm-hmm.
and that was because my resume was light. And so, much of this world, if they don't know you, if you weren't referred in by someone that they know and trust, they're just looking at a piece of paper. And my piece of paper didn't tell as strong of a story as some others. And so that was a little telling. But then, we got to the second round interviews, and the guy that had 13 was down to 7, and the guy that had 9 was down to 4, and the guy that had, 9 was down to 2, and I still had 3. So it's like, okay, this, getting the interview is one thing, killing the interview is another thing. And so at the end, I was the only one that had an investment banking job, because I had 3 final interviews and I was able to secure that job. Now, this was back in 1987, and a little problem in the finance world called Black Monday happened in October. And so almost everyone at my school, there were 860, I think, that graduated in my class. And there were probably 800 investment banking job offers that had been given because of internships. I think all but a dozen were canceled.
Wow.
Because Wall Street just shut down. They fired all their analysts. They got rid of most of their associates. They were just cost cutting everywhere they could because, one of the biggest events in stock market history had occurred. I happened to have taken a job offer with an organization called Chemical Bank, and it was their global corporate finance group. They didn't have anyone to cut. They were just starting. It was a startup. And so I didn't have my job revoked. And so I was one of the few that kept the job offer and went and started and then pursued that career.
Love that. And what are your thoughts, Brian, on pursuing an MBA? I think, now it's probably viewed a little bit differently than it was then. But what advice would you give to somebody who's considering going back to get a master's degree versus continuing their experience or doing something more entrepreneurial? What are your advice there?
I have a couple thoughts on it. One, not all master's degrees are created equally. If you have a liberal arts degree and you need to learn about business, then that's a good pivot, and that's a good way to learn. It's a great way to build a network, but it's so much easier to network in society today because of social media and all of the clubs and organizations, and so it's replaced potentially part of the reason why people would go to an Ivy League MBA school. I'm a huge fan of the executive programs, and many of them don't even call them executive programs. They're just weekend programs. And so many people at Portfolio Advisors who wanted to get that master's degree went and did the Friday, Saturday program or the Saturday only program. and they're crazy expensive, $250,000 or something like that. But you're working while you're doing it. You're able to apply everything that you're learning, and you can graduate with no debt. I mean, I graduated with a bunch of debt. And so, there's a place for people to hit the reset button, to walk away from their career and to go to school, because it's a great way to change industries. But if you found the industry you like, in particular, if you found a company that you like, why would you walk away from it? And so we've had people that have, gone and started school and they're senior associates, and when they finished school, they were already promoted to a vice president or shortly thereafter promoted, and they're making a lot of money. And so it's kind of like I'm upgrading my skills. I'm not completely changing my career.
Yeah, that's great. I think that's great advice. So it was Chemical Bank, that was the name of the firm?
Yep.
So how long were you with them, and kind of what was that role like on the day-to-day?
It was a fascinating time because when I started my career, there were no cell phones. We had a pager. You wore suspenders if you were on Wall Street. And I was excited when the fax machine came out. I thought, man, this is going to be transformational. Didn't have email yet. But it was a crazy time because there was a significant amount of consolidation in the banking world. And so Chemical Bank was the fourth largest bank in New York and one of the largest in the country. It then merged with Manufacturers Hanover Bank to make an even bigger bank. That created a lot of turmoil. And so I had won this really cool assignment, but my boss left. And all of a sudden, I didn't have a boss, and everyone is kind of scrappy, running around trying to figure out how did they win in this merger. And it looked like a very dangerous place to be. And so it was at that point in time. So I had been there for 3 years, and I had won this really nice assignment with the state of Kansas, turning around a private equity portfolio that was broken. And we had done a really nice job for them and had built some nice relationships there. And so I approached them and I said, I have no idea whether I'm going to have a job in 6 months at this bank. I don't have a boss. We love this assignment. I've got another firm that's offered to start a new business that could take over this assignment. Would you consider backing a 30-year-old in a startup? And they said, you know what? We really like you. We like the team that you've put together. You've performed for us. It's okay. We don't need one of these big banks. And so we started a new firm called Morris Anderson Investment Advisors. I partnered with a turnaround consulting group out of Chicago, and the state of Kansas transferred the contract. Much to the dismay of Chemical Bank, but it was really chaos. Now they then went ahead and merged with Chase, which then merged with JP Morgan. And so there were like 400 banks in the country that turned into 5. And so it was during that time, exciting time, but also felt a little risky. So moving to the entrepreneurial side, convincing a great foundational client to back us was really transformational for my career, because when I started Portfolio Advisors, that same client came with me again, and that became the largest revenue source for Portfolio Advisors when we started.
Yeah, I mean, it goes to show the value of relationships and just continuing to build those over your career. And
absolutely,
I think that's great. So you were 30 years old when that transition occurred. What was your role in that newly formed company prior to Portfolio Advisors? But what was your role there when you brought in that when you started that other firm? It was Morris
Anderson Investment Advisors.
Yeah. What was your role there?
It's interesting because I had a great job at Chemical Bank. It was one of these 2-year rotational programs and training programs. So you got to work in different groups. So I got to work in the M&A group and the merchant banking group and the leverage leasing group, and thoroughly enjoyed it. In fact, one of the most interesting ones was the loan syndication group, because Chemical became the #1 bank on the street for syndicating bank loans. And they would take a $500 million loan, break it into $5 million pieces, and sell it throughout the world. Very, very lucrative business for them. And so in that training program, I got to meet a lot of really interesting, capable people. The last group that I worked in was called the Restructuring and Reorganization Advisory Group. And basically, it wasn't the workout group of the bank. It was a group that was an external advisor to either a company or a creditor committee for a broken LBO. And so, having interest in the private equity space, learning the underbelly, what happens when buyouts fail, was a pretty interesting experience for me. And my boss was a fellow named Arthur Newman. And Arthur was kind of the top guy on the street, or one of the top guys on the street, for providing advisory services for creditor committees. And so he joined our bank, and I was the first associate that he selected for his team because of this rotational assignment. And I got to work with really bright, capable people there. Well, Arthur announced he was leaving to go to a startup or a new merchant banking house, and that that it was just so financially compelling. He was going to walk away from this really big job at Chemical to do that. And he was going to take everyone on the team with him. And we thought, whoa, what's this place called? And he said, it's called Blackstone. And so Blackstone was teeny back then. They had one small fund that was maybe $50 million. Wow. And so he was going to start the restructuring group at Blackstone. And big salary, big equity opportunity. And it proved to be a massive win for him. But the bank pushed back. The bank said, whoa. Your group is the most profitable group at the bank. You can't walk out the door, take all the clients, take all the people, and all the profit.
Yeah.
And so Arthur negotiated a good deal for himself, and he basically agreed, I will leave half the people there. I'll give you a chance. But all of the contracts had 30-day termination clauses, and all of them could walk out the door.
Oh, wow.
He took all the MDs, all the SVPs, and all the VPs, and he drew the line at the associates. And so I think he took one token associate, and he said, I got to leave you here. And it was interesting because one of his lieutenants, who was a guy that I greatly respected, I said, okay, you're taking that associate. Why aren't you taking me? Mm-hmm. And he just said, I don't think this is the career for you. Brian, you look for win-win solutions. What we want and what we need in this really nasty business, because it's turnaround, restructuring, bankruptcy, pre-packs, all these things. We need someone that'll slice someone open, reach in, grab their entrails, feel through them, find any nickel that's in there, and cut it out. You're not that guy. I said, you're right. That's not me. I'm much more of a long-term investor. I do look for a win-win. I like fairness. And so they left, and they had a wonderful, wonderful career in business. But that departure, I had 30 days of revenue because every client left.
Yeah.
And it was in that 30 days that I went and found this turnaround consulting assignment with the state of Kansas. As a 30-year-old guy, how do you go pitch the governor of the state of Kansas and have any confidence you're going to win? So I went and I grabbed a managing director that I had worked with on some M&A deals, and I said, hey, Bob, how would you like to work with me? And he said, I'd love to work on this assignment with you. And so he came and he said, what role do you want me to play? I said, I need you to be the senior ambassador, interface with the governor, interface with the board. I want to be the portfolio manager. I'll manage all the people, and I'll just kind of bounce ideas off you. So we'll be like partners. He goes, let's do it. And so it was a huge opportunity for me. I was drinking through a fire hose. I ended up having to take an apartment in Kansas. I was spending 5 days a week there. It was an amazing experience, but we took a portfolio that had hundreds of millions of dollars in losses. I mean, basically I had to write the thing down by 75%. And we ground it out, and we finally got all their money back, and we got it to a 15% positive return. And that's why they were willing to move the contract. And they moved it again to Portfolio Advisors, and then they gave us $1 billion of fresh capital because we had done a great job. And that was really the engine that really kind of caused Portfolio Advisors to scale.
So was this like a separately managed account for the state of Kansas that your Chemical Bank was working on? You guys set a separate contract.
We took over 69 investments in all different kinds of companies, mostly in Kansas, but there were some spread around the country. Agricultural belting, animal feed. Because you're in Kansas, there's a lot of agrarian kind of stuff. But there was video distribution. There were software companies. It really covered like 20 different industries. So as a 30-year-old, I got to be on 14 boards. I was the chairman of 2 boards. I was the chairman of several audit committees. Like I said, it was like drinking through a fire hose. And I met with this old VC, and he was in the portfolio, and he just said, you're getting your PhD in finance from this thing. And I said, yeah, I'm learning so much. I said, it's a little tough on my wife, and she was taking care of the little kids because I'm gone so much, but this has been absolutely fascinating. And this was the guy that gave me one of the great pieces of advice. He said, look, you're young. He said, don't focus on how much money you make. He said, focus on what skills you're getting and whether you've identified the industry you want to be in and the company and the job. be prepared to either be in that job when you turn 40 or have identified it and be close to getting it, because all the wealth you're going to create is going to be after 40. It's just plain up until 40. So learn the skills, get the credentials, and develop the reputation so you're ready to really step on the gas when you're 40. And that made a little bit of sense when I was 30. But as I've gone through my career, I realized he was spot on. I mean, you make so much more money last year than you did when you were 25, right? And so whenever I teach on campus, I tell the students the same thing. I said, this was advice that was given to me. I'm sure it was given to him, and it's proven to be absolutely correct. And it's something that you ought to think about.
I love that. Such good advice, Brian. So you're working with the state of Kansas. You spin off a chemical bank. How long did that venture last before you started Portfolio Advisors?
So I was at the bank for 3 years, had that assignment for 1 year before I left and founded Morris Anderson Investment Advisors. So I was 30 when I founded Morris Anderson.
Okay.
And then I realized, you know what, this is a great firm with really good people, but this is a side business for them. They're really a turnaround consulting firm. And turnaround consulting firms do great when the economy stinks. And they struggle a little bit when the economy's booming because there's not as much turnaround work. And so I thought, they're not really focused on our business. They don't want to give us the resources to grow. In fact, they want to suck resources out to help cover their bonuses when their business was struggling. I have the wrong partners. Not bad people, just the wrong partners. And so when I was 35 years old, I left. I partnered with another fellow and 2 fellows, and we started Portfolio Advisors and moved from there. So one of my partners had just taken early retirement from General Reinsurance, which is a big insurance company that is owned by Berkshire Hathaway now. And he had built a $400 million private equity portfolio, investing in funds. And he was able to take early retirement and start a predecessor to Portfolio Advisors. It happened to be called Portfolio Advisors, Inc. And he needed a partner. And so a headhunter called me and said, you got to meet this guy. His name's also Murphy. And so I met him and I liked him. And I said, you know what, if Kansas would come with me to this new company, which is, we just made it Portfolio Advisors LLC, because I told him, I said, look, you're old and you're retired and you only want to do this for a couple of years. I want this to be my career. So I need it to be more tax efficient. I need it to be something I can scale. So we completely restructured it, moved the headquarters, put it down near where I lived. And then he and one of the associates he had and I formed the new business. And so he had Gen Re, which was investing about $80 million a year. State of Kansas came with us and they were investing about $200 million a year. And shortly thereafter, they gave us $1 billion of fresh capital. And so, having 2 clients matters. It's really hard to get your first client. It's not that much easier to get your second client. And getting your 4th and 5th are much easier. And so having solid revenue, being able to hire people, allowed us to kind of slowly march our way along. One of the things when you go out to get a separate account is there's a condition precedent that says you have to be in business for 5 years. So there was business we wanted, but that we just weren't qualified to have. And so we built a monitoring and reporting business, and we picked up some separate accounts from corporations and people that didn't have some of those public rules. But once we had that 5 years of experience, we won state of Pennsylvania, state of Indiana. We currently manage money for the state of Utah, and lots of others. And so it was really fun to kind of figure out, okay, how do you grow a business when you have impediments in front of you? That's kind of always the game that you have to play. And we were very fortunate that the industry grew, that I found really terrific partners. Entrepreneurship is not a one-man game. You need people you can trust, people that, frankly, complement your skills. And I found great partners, honorable, hardworking, capable people that complemented me, and we built something that became very special and much bigger than we ever thought of.
It's amazing. How did you, I'm curious, on the partnership structure between you and your 2 partners for Portfolio Advisors LLC, how did you divvy that up? I mean, roles, responsibilities, and then equity and ownership.
I came from an investment banking background. My other one partner came from an insurance background. And, we kind of said, look, let's run this like a financial services business, not like a traditional true partnership. Because we didn't know if we'd ever get into the fund business. At that point, it was really just a specialty consulting business. And so having a salary, having a performance bonus, it allowed people to work hard and add value and then be paid based on that contribution. And so we never really said everyone has to be paid the same. And there's some firms where everyone has the same salary, everyone gets the same carry, everyone's comp is exactly the same. I'm not sure how that works. I mean, I think that there are lots of examples where not everyone's making the same contribution. Not everyone's in the same point in life. And so you want to bring in really capable, hard-charging young partners, and you want them to be able to grow and develop. And if they always feel like they're undercompensated because you don't have a variable compensation mechanism, you're not going to keep them, and that's going to hurt your business. And so we were fortunate that we were able to kind of get to that 5 years, start to pick up all of these advisory accounts, and then we quickly pivoted into the fund business to add that because it's got a tremendous staying power, right? You know, a fund of funds, which was our first product, is a 15-year contract. It's basically a 15-year non-cancelable contract. If we don't commit fraud, we have your money and we're investing it and we get to charge you for it. And so you could kind of raise those funds and the revenues stack, and then you have a much more kind of predictable model on how do you staff and how do you build your costs and how do you maintain your margins. And so that was a nice add to the consulting business, which tends to be lumpy. But it gave us enough revenue that we could say, okay, you know, how do we pay people who are raising capital? There's a real benefit to raising capital or finding new clients. How do we pay the people that are making the investments? How do we move into the space where you get incentive fees, right? You know, in the early days, you got paid a flat fee as an advisor. It didn't matter what your returns were. It didn't matter how great of a job you did. Either they kept you or they fired you. How do we move into the space where if we generate really good returns, we can get a piece of that action? And how do we share that with people? And I don't know, my thesis from the beginning was I want everybody to win. I've seen a lot of businesses where one guy owns the whole thing or two or three people. And I said, I want a business where we share equity across the firm. I want it to be there to attract and retain talent. I want everybody to win if this succeeds. It's not just how does Brian win? And so one of the terrific outcomes with our merger with FS was I counted that we had 85 millionaires in the firm because we had shared equity liberally across the firm. And so it allowed people to kind of accomplish an important financial objective in their life and, you know, take a little bit of the pressure off. But we also had a lot of people that were going to make really good money if our funds performed well because we had carried interest that we had been able to start to secure.
Yeah, aligning those interests is really important. I think the way that you approach it is absolutely right. I've worked in similar groups where it tends to be a handful of people who have all the carry or the upside. And so I think spreading that out, properly incentivizing people is the way to go.
I think in the last fund that Portfolio Advisors raised, there were 70 plus people that participated in carry. So
that's
people
awesome.
say, well, that's crazy because, you know, as the founder of the last fund, you got 4% carry, not 30. It's like, you know what, 4% of a big fund that does really well and that we're able to raise a fund, every year because we have multiple strategies will create sufficient wealth for me. And so part of it is, you know, what is wealth to you and what are you trying to accomplish? And, you know, obviously you've got the first tier, which is you want to pay your bills. You want to make sure you have a safe place for your family. Everyone's fed, and you kind of have a long range beyond that. But I've always encouraged my kids and others, figure out what lifestyle you really want and then calculate how much that costs and work really hard to get there. But, you know, the game of running as hard and as fast as you can, sacrificing everything, your marriage, your relationship with your family and friends so that you can accomplish some mythical wealth number, seems like a bad trade. And so figure out what you're willing to sacrifice for success, but what you're unwilling to sacrifice, and make sure you manage your life accordingly so that you get there with all of the, you know, the assets, including family and happiness and health and all those other things, so that you have a happy life. And many, many people sacrifice a happy life just in the pursuit of wealth, and it's very sad.
Yeah, it's great. It's such great advice, Brian. Appreciate that. So just to clarify your business model for Portfolio Advisors. So as is noted in the name, you were at an advisory firm for separately managed accounts. So you
that's
go
how
to
we
state
started.
of Kansas and say, hey, you guys have $200 million you're willing to allocate to us as your advisor. And so you would strategize how you'd invest those dollars across private equity, stocks, bonds, private credit.
So we were a specialist, and so they had a general consultant, and that general consultant would determine what their asset allocation would be. And they say, you should have a chunk that's in private equity.
Yep.
And then they would say, okay, we need to hire a private equity specialist. And so many times we were hired to do that. We had a couple of clients that said, we have an alternative allocation. So that included real estate. That could include infrastructure. That could include other things. Credit was always part of private equity in its early days, but now it's kind of split out to be its own separate sub-asset class. And so now you can get a special mandate just to do credit, or you can get real estate, or you can get infrastructure, you can get private equity. Some go as far as, I want to hire someone just for venture capital, which we view as part of the larger private equity ecosystem.
Yeah. So as portfolio advisors, 200 million's coming your way from the state of Kansas. What was your specialty in that at that time, or what was it generic and broad? Were you taking that 200 million, divvying it up?
When we were in the early days, we were all generalists.
Yeah.
And so I wore lots of hats. I wore a hat of, I'm going to be a fundraiser. I'm going to go out and find clients. I'm going to be sourcing deals. I'm going to be doing due diligence on deals. I sit on the investment committee. Got to make sure that we do all the proper reporting. And so you really kind of had to understand everything. And, I like that, because most entrepreneurs, they fail because they don't understand a part of their business and somebody runs amok. Mm-hmm. So starting a business and knowing how everything works and then being able to train and delegate gives you far more understanding and power, and that's important. What I ultimately made a trade, and it was a really big trade. I told my wife, I said, look, we've been in the market for 2 years trying to raise our first fund. Very different business model doing advisory versus fund management. It's a completely different fundraising process, and you need to have different systems and things. And, we would sit down for a marketing meeting, and I'd say to my partner, okay, how many people did you meet last month? I met with 2. And this guy met with 1. I said, well, I met with 3. That's not going to get us there. But we all had the legitimate excuse that we had so many other things that we were doing as generalists that you kind of had to take care of your existing clients before you brought on new clients. But it wasn't going to get us to where we wanted to go. And so I went home and I told my wife, I said, I'm probably the shyest person out of this group. I probably am the least prepared to be the best salesman for this company. But someone needs to do it, and I think I need to step up and volunteer. And so I told my partners, take over a significant piece of my due diligence responsibilities. And I will stay on the investment committee, but I will head up the fundraising business development side. And if we're going to be a fund manager, then someone has to be accountable for raising the funds and making this happen. That's put me on the road a lot. I mean, I've flown 6 million miles. I've flown around the world 250 times. Wow. It's what allowed us to, open an office in Zurich, and then in Hong Kong, and then Singapore and London and Dallas. And we have over 3,000 clients at Portfolio Advisors. So it is important that I mentioned that when we did the merger, I stepped down as the managing partner of Portfolio Advisors. So I'm actually not an employee of Portfolio Advisors anymore. That gave me the opportunity to transition and become a senior advisor to the Office of the Chairman for FS. And so when I say Portfolio Advisors, it's because I'm used to speaking that way for the last 30 years, but I'm no longer running Portfolio Advisors. It's a wholly owned subsidiary of FS, and I have a senior advisory contract with FS so that I can kind of work my way into retirement in 5 years, because it's a 5-year contract.
Makes sense. Well, it's incredibly impressive, the size and scale that you were able to accomplish, Brian. I mean, 38 billion and now 75 billion with FS. So transitioning from separately managed accounts, I mean, when you started 35, 200 million from Kansas, another 80 with your partner's relationship. So you have 280 million you're managing. Were you charging about a 1% fee on that? Was that kind of standard, or what?
No, that's the tricky part about the advisory business. I think our highest fee client paid us 100 basis points. No carry, no incentive fee.
Sure.
Our lowest paid us 5 basis points.
Wow.
And so the size of the contract, what they want you to do, how many resources you have to apply to it, kind of drives it. And so we had one contract. It was a client, the Pennsylvania Public Schools. we deployed anywhere from 1 to 5 billion a year for them. So because of that scale, they're not paying 100 basis points.
Sure.
So they got a really, really attractive deal, but it was also a great piece of business for us. And so that, the fact that those advisory contracts had 90-day or to 180-day termination, and you get board changes and there becomes politics involved.
Yeah.
You're always kind of hanging on by your fingernails. You could be doing a great job, but it doesn't mean they won't swap you out. And sometimes you're swapped out legitimately. Sometimes you get swapped out because people are doing something inappropriate.
Yeah.
They're on the take, or they just have a really strong preference for one, and no matter what, they're going to get those people in there. And so that's a nice business, and we like to have a presence there because we deploy a lot of capital. It makes us important in the investment ecosystem. Portfolio advisors invest about $3 billion a year. So that makes you an important player. And you're an important partner for general partners. But it is not a high margin business. And in the world of valuation, it doesn't get assigned a great multiple because it could terminate in a very short period of time. The asset management space is where the real value is. And so, you launch a fund and it's got a 10-year life with multiple year extensions. We have products at Portfolio Advisors that are fee only, and we have some products that are fee and carry. And the goal over time was, how do you continue to build your track record and your reputation so that you can keep migrating and charge incentive fees? So we charge a fee and an incentive fee, and that's where a lot more wealth opportunity is. But your clients don't mind paying you that because you've already hit a minimum bogey, like a preferred return of 8 or 10%,
Yep.
and you're sharing profits beyond that. And so that was kind of our big pivot. We moved from a pure advisory firm to adding asset management. That was fee-only asset management, and then we started to add direct investing. So co-investments, direct lending, secondaries, and things like that, where we could charge an incentive fee. And that became a really, really valuable thing. The thing that actually got FS most interested in us was we launched a 40 Act fund, which is kind of in the mutual fund space. And, Partners Group had done a wonderful job doing that a decade plus ago. And they showed that there was a tremendous amount of interest in the high net worth and ultra high net worth space to participate in a vehicle where you could put 100% of your money in at one time. There were no capital calls. And you could leave it there until you decided to take it out. And there was quarterly liquidity. And so they proved to the world that you could have private assets in a semi-liquid form. And so we wanted to be in that space. And so we launched a product in that space and got it over $500 million. FS very much wanted to have a 40 Act private equity fund. They were very big in credit. They had a very large BDC with KKR. And so they were a great company, and all of their business was on the wealth channel. And they wanted to add our product to their platform, feeling that, they could probably get to the point where they're raising $100 million a month and scale this so that it could become over time over $10 billion. And we had the investment capacity to get it to $10 billion, and they had the marketing acumen to get it to $10 billion. And so that was kind of part of the industrial logic on why we wanted to do that merger. And so they were the wealth retail side, we were the institutional side, and we could share products by repackaging what we did on the institutional side and move it over to the retail side and just have a bigger, more robust, evergreen, and profitable business.
Yeah, I mean, it makes perfect sense transitioning from the advisory to the asset manager, the fund space, and the incentives you mentioned and how you structured it. I did want to ask Brian, when it comes to raising capital, you mentioned that you'd pivoted from the DD and doing a lot of that to focusing on raising capital. I mean, what you've done is incredible. And as an investment firm ourselves, right, we're always thinking about raising capital. And I mentioned my background, but our aspirations are to be more focused on institutional clients, institutional capital, pension plans, et cetera. But what advice would you have there? I mean, how do you get introduced to these players who are writing $100 million checks? How do you sell to them? What's that process like?
One, it is hyper competitive. When I talk to a potential client, it is not at all uncommon for them to say, I see 500 to 1,000 deals a year. And how do you get their attention? How do you differentiate yourself? And that's where relationship matters so much, because, most people feel life is too short to work with a bunch of people that I don't like or don't trust. How can I validate and verify something? There are lots of really good managers that can get you a return within a certain parameter, but how good is their client service? Do I trust them? What is the kind of organizational and governance structure? How stable is it? I mean, you look at firms that have just constant turnover. And if you're signing up for a 10 or 15-year partnership, you don't like that turnover. You want to make sure that the people who you diligenced are going to be there to invest your money through the period and harvest it. It's a long-term thing. Are the incentives set up so that it will reward them for doing what you want them to do? Or is it maybe set up that kind of heads they win, tails they win? And there are quite a few asset management contracts we look at and we think, well, it's easy to see why the general partner likes this, but I'm not sure how the limited partner is going to win in most circumstances. In fact, sometimes they might not win in any circumstances. So a lot of it is, how do you get in the door credibly? How do you explain to them what it is, the value proposition that you have, and make them comfortable that you can deliver on that better than so many of the other people that are kind of beating down the door. I've kind of teased people. I have friends that have done a lot of deal by deal, and I say, why would you ever want to leave that world? I know that there's some cachet to having a fund, but it's a whole different bucket. And, you get a whole different spotlight from the SEC because you now become an investment manager instead of a deal, manager. And so there are many, many, many ways to run an investment business. And there's lots of great and successful models. And there are some that did the sponsor lists and they did deal by deal, and then they became the fund. And there are funds that have now, they make more money doing deal by deal. There are some, I've met venture funds where they raise a $100 million venture fund, but they end up doing $400 or $500 million of SPVs for the follow-on rounds in their deals. And they make far more money from their deal by deal SPVs than they make from their fund. So it's just kind of, what is it that you want to become? There's always rules, regulations, challenges in any business model. You just kind of have to decide which ones that you want to take on and which ones don't you.
Yeah, makes sense. And I worked in the fund space. I've done direct deals, and I totally understand from a governance regulatory standpoint with funds, it's a lot more work. You need a whole team.
You need scale. You don't want to do the fund business subscale because it's then just mostly a headache.
Yeah, it totally can be. So it makes sense. So I am curious, when it comes to introductions to these groups, I've heard there's placement agents, there are brokers, but what's been successful for you? I mean, if a group wanted to get in front of the state of Pennsylvania or the state of California's fire department, pension plan, like, how does somebody get access to them? How do you make an intro? How have you been able to be successful with those initial conversations?
We have successfully used placement agents throughout the entire time as a firm, partly because they do have relationships at these organizations, and the organizations, if they're well respected, will take the meeting. So at least they get you in the door. They're really expensive because they're charging you a year's worth of management fee, sometimes 2 years worth of management fee. But many organizations find themselves with less capital and more deals, and so that opportunity cost just isn't that big. And so you'd say, well, if I can bring in more capital, it's okay if I make 80% of the money. And so when we wanted to expand our client base, we found that placement agents were very good partners to do that, especially internationally, because they're local. And so that worked. On the other hand, if you start to build some scale, it's cheaper to hire full-time salespeople and pay them well than it is placement agents. But it's kind of fixed cost versus variable cost. And so as we grew over time, we increased our internal marketing team and reduced what we did with placement agents. But I think Portfolio Advisors has 8 placement contracts right now in different parts of the world. So they still have a very viable place. I think nirvana, people think, I know I finally hit it when I don't have any placement agents. Mm-hmm. maybe.
Yeah.
we portfolio advisors never got there.
Yeah.
But we were able to grow tremendously. We had one placement agent over the years that brought in $4 billion.
Wow.
And it was just kind of locking arms and working hard together, and they were a tremendous marketing partner for us.
Yeah, that's amazing. Well, that's great to know. Would you say that from a deal by deal versus fund, are you seeing, has there been a shift at all recently on some of these pension plans or state groups that, I'd rather see a $50 million real estate project just isolated, or I'd rather go invest with a fund that's diversified. What's the mentality there, preference that you've seen?
It's been a gradual shift that's accelerating. 20 years ago, there were only a handful of very sophisticated private investors that would do a co-investment alongside the GP, and even fewer who could actually had a capability to source a deal, analyze it on their own, and make that investment. For example, many public pension plans were just not staffed with those kind of bodies. But over time, people realized, the private equity asset class is wonderful, and it has, the top part of the asset class has beaten the public markets consistently. There's a lot of pay that goes to the general partner. They're very well paid. I mean, you look at the Forbes list, and you have a lot of private equity professionals that have now hit that Forbes list. And you say, okay, so this is lucrative for both sides. But if I'm a big investor and I keep building my portfolio, I'd like to over time average down my fees. And the easiest way to average down your fees is to do co-investments alongside those general partners that you've entrusted so much capital with. And most in the private equity space, most co-investments, when you're a large investor, come to you fee and carry free. So it's a great way to average down the costs. And so large sovereign wealth funds, some of the large public pension plans, some of the large endowments started to say, we're going to put a higher and higher percentage of our money in that, because if I can add 100 basis points just from a fee arbitrage, that's a lot of money when you compound it over time. And so I was talking to one general partner, and he, a couple of years ago, and he said that he believes that 30% of all private equity now is invested through co-investment, not through the fund vehicles. So it's become a big piece of the private equity landscape. It's also moved its way all the way down to the high net worth level. There's even some local groups that have done a terrific job in offering deal by deal. I mean, you guys are one of them. And they're saying, hey, do you want to put the money in a blind pool fund? And many people who don't have a lot of the time or interest will, and that's a great place for them to get the return. For the ones that might be, wanting to get involved, and they want to either have the financial stimulation or just, the cocktail chatter, I did this deal. More and more people are going deal by deal. And that trend, I think, is only accelerating.
Yeah, that makes sense. And we've kind of seen that as well. When we put together, as I mentioned, we're doing deal by deal, it seems to be the preference. They like to isolate, we've underwritten this deal, we like the sponsor, we like the opportunity, let's deploy capital. Because when you look at a fund, pros and cons, you get diversification, but there's you're blind, kind of going in blind a little bit with where you're eventually going to be allocated. Well, I did want to ask just on how you guys, so you have different verticals, private equity, real estate. When you're looking at a sponsor, so for example, a group like us or some group coming to portfolio advisors and saying, hey, we're raising a fund, or we have a direct deal, or what have you. And maybe this isn't how it works with you guys, but how do you underwrite sponsors when real estate groups or others come to you to look for allocation from your vehicles?
So the first question, or one of the first questions that you ask, is, do we actually have a client fit for this product? I've always used the example, I just never had a client mandate for a Pakistani buyout fund.
Sure.
So there are funds that come in that you say, yes, there's no fit, don't spend any time on it. But anything that does fit within kind of the parameters, if it's in the private equity space, the real estate space, the credit space, the first question is, does this group have experience? And there are lots and lots of first-time funds. We have some clients that want us to focus on first-time funds because they're trying to build that ecosystem. Sometimes they'll have an LGBTQ or a women minority tilt, handicapped veterans tilt. And so people will allocate their capital to accomplish certain goals. And so most people don't put a lot of capital into the first-time funds just because there's always startup risk.
Yep.
These are not easy vehicles to manage. They take a long-term commitment. And sometimes you get somebody that was a great lawyer or a great investment banker. They work on it for 2 or 3 years and they say, I don't want to do this anymore. And so we do look at that startup risk. We want to look at, it's a lot of pattern recognition. What have they done before? Why was it successful? Do we attribute it to just all boats rising on the tide, or did they source well? Did they add value? Did they increase the EBITDA? Did they make acquisitions? Did they source management? What is it that they did that drove that return so that you could say, is this replicable? Can they do this again? What industry is it in? How do we feel about that industry? What size of deals are they doing? If it's too small, then it might have a risk profile that's not interesting. If they're too large, do we think that they can really meaningfully outperform, say, an S&P index where you can pay 4 basis points or 5 basis points? So we're really looking at the people and the strategy and the track record and our view as to, do we believe that this will work? And I always tell people there's 2 return metrics I look at. One is an absolute return. And you can find many funds that meet your absolute return objective, but you only need 20% of those. And then the next one is a relative return metric. Okay, let's say there's 10, venture funds that focus on SaaS space. Who do we think the top 3 are? If I can't get into 2 of the top 3, then I need to get into the one and then maybe add in a second one or a third one. If I can get into the top 3, then even though the other ones all look great, I just don't need them. And so you don't want to have a non-diversified portfolio. You want to make sure it's appropriately balanced. So that's the kind of stuff that people look for. And the hardest part is you're turning down some really, really good managers. And, I always tell the junior people when we did training, when you deploy $3 billion a year, if that money doubles and there's a carry, there's $600 million. So you're almost allocating $1 billion of fees and carry every single year. If you give someone a $100 million investment, you're making someone a millionaire. And you're going to be incredibly popular. Don't confuse the fact that you work for a firm that deploys a lot of capital with you're brilliant and everyone loves you. Because the minute you walk out the door, they forget about you and they focus on where the capital is. We're all part of an ecosystem. We have a fiduciary duty. We have to make sure that we're investing that money well. And when we do invest it well, things tend to work out well. If you invest it poorly, things tend to go poorly.
Yeah, makes sense, and great advice for sponsors, emerging fund managers who are looking for allocations. Last question, just on that average check size for you when you are allocating to a fund or sponsor. It probably varies for you guys, but what does a typical check size look like from portfolio advisors or FS investments into an opportunity with a group?
So portfolio advisors would invest, around $5 million at the low end. Mm-hmm. And, we've had clients that have agreed to write checks that are $300-400 million in size. And so you get a large public pension plan and they can say, yeah, we can be 25% of this fund and they're raising $1.5 billion. And so we'll come in for 25%. So it really covers the board on a fund of funds. It's very common to invest $10, $15, $20 million because our funds have always, the last 6 or 7 have been around $1 billion. And you want to make sure you have appropriate diversification. And so across multiple choices, doing $10 to $20 million commitments would mean you could have a venture bucket with 15 funds in it. You could have a buyout bucket with 15 funds in it. And so that's what they look at is how do I build a distinct sector portfolio, properly diversified, but spread across the very best of the best managers.
Yeah, makes sense. That's great. Well, last couple things, Brian, we'll wrap up here. The merger with FS Investments. I mean, congratulations. I mean, that's incredible. What was that high level for you? Was that something that you were extremely excited about? Was it kind of like the end goal for you with portfolio advisors to merge and kind of spin off? Or what was that experience like?
So we were approached almost every quarter by someone that wanted to talk strategic because we had built a really nice business and there's a lot of consolidation that was going on in the secondary space and in the private equity funds management space. So we weren't in the market. And so when I was contacted by FS, I said, we're not really interested. And they said, well, you haven't let us explain why we think this is a brilliant idea. And when I had a chance to talk to Michael Foreman, who's the founder and chairman of FS, it became pretty quickly clear that there was some real industrial logic to putting the two firms together. That said, even though it made tremendous amount of logical sense, and we quickly identified as we did our diligence that these were really capable, high caliber business people that you would want to partner with. I kind of tortured them because I wasn't sure I wanted to go from being the managing partner to being a division of a much bigger company. And because it wasn't our idea, it took me a year to kind of get my arms and my brain and my heart around that to say, okay, we're going to go from being a successful independent firm to being a subsidiary of a bigger firm, which is going to have more process, more analysis, more committees, more management, because you have to have that to run a big successful firm. So for me, it took me about a year before I finally convinced myself, you know what, this is important. As I talked to my friends, and particularly many of my friends, we're involved in the National Advisory Council for BYU's Marriott School, and I'm on the board for the Woodbury School. And as I talked to my friends and just said, how should I be thinking about this? They all said, at some point you need an exit. And the tricky part about having a successful private company is I wanted to have a business that everybody could be proud of and have job security and continue to do even better than they had done. And I just wanted to make sure that we were positioning it that way. If we stayed independent, it became increasingly clear that we had enough founders with enough stock. It wasn't an if we were going to have to sell a majority of the company. It was a when. So then it comes down to, well, if you wait too long, the best dance partners are gone. Right now, we're still being a little early in the game. Let's pick the right partner because this is an eventuality. And it was, instead of waiting 5 years when I am going to retire, let's do this early enough so that I can participate in the transition and help to the joint organization grow and develop. And that's finally where I kind of came down. This is good for our clients. This is good for my PA employees. This is good for the combined company. And this is good for my family. And that all kind of, once that was all put in place, then the merger happened, and it's been a terrific merger. We're accomplishing some really exciting things. We're looking forward to the future.
Fantastic. That's great. Well, what is some last advice that you'd share, Brian, to entrepreneurs or those looking to start a business? I know that's kind of broad. But is anything that you've taken from your career? You touched on a couple things, but that you'd share with budding, aspiring entrepreneurs?
My life has not been, I'm at point A, I set a goal for point B, and it's a straight line there. There's a lot of bobbing and weaving. You have setbacks, you recover. Then you have points of acceleration where things go far better than you ever dreamed. And then you get kicked in the face. I mean, I think that's life and that's entrepreneurship. And so one is be tenacious, be willing to work hard. An entrepreneur, some people think of entrepreneurs as these fat cats that just go out and play all the time and they don't have to work hard. That has not been my experience. Maybe there are other people that are far smarter than me. I found it to be wonderful to be in charge of my destiny, be accountable for the successes and the failures, and be able to pick who I work with. Surround yourself with really good, capable people. And so from that standpoint, think about that, do it, work hard. And grow, but be open-minded that you might have to pivot. You might end up in a different place in 3 years than you started. The world's changing quickly, and how do you keep up with it? It's the old Wayne Gretzky, how do you skate where the puck is going, not where it's been or where it is? And I think that has been an important part of our success. We were thoughtful in thinking out 3 years from now, 5 years from now, 10 years from now. We were smart at going where the puck was going. And I had just really great support from people that kind of moved me along, and tremendously supportive wife. I mean, she kind of had to run the entire household while I was out running around building a career. And we'd always check in with each other. How you doing? Can you make it? Sometimes I wonder if I can make it. Let's do this together. And so now as we come out the back end where we have a lot more time and we're doing a lot more travel and philanthropy, our relationship is stronger than ever. And that's really important because I have many friends that their lives didn't end up that way.
Yeah, that's great. Well, last question for you, Brian. This is something I ask my guests, and Goes with that last point. But when you think about life in general and success, the buckets that we have to think about in life, what does a life well lived look like for you, and how do you define success?
I guess I don't define success as how much money do you have. I always tease people that I would never become a billionaire because I would give it away too fast. I was always raised that, live a great life and spend your time lifting others. And, if you succeed by stepping on other people and crushing other people, yeah, you might have won in one aspect, but you've probably lost in a lot of other aspects. So, how do you live a quality life? Clayton Christensen had a book about, how will people measure your life? And I'm a believer in that. I want to make sure that I've lifted people. So I take tremendous pride in how many families have done extremely well being part of my financial family, and how many more will do well because of the foundation that we've created. My wife and I have, had the goal of giving away 25% of everything we've ever made to charity. And the richness of making a difference in people's lives, and helping with scholarships. And my wife's on a board for single mom scholarship funds. And we've been blessed with far more than we need. And what is your obligation or your opportunity with those resources? And we've really enjoyed focusing more and more time on that.
Great. Well, no better way to end, Brian. Thank you so much for sharing your story. Very insightful, and truly appreciate your time.
It's great to be with you.